Once you start to realize that Bitcoin is the only thing that can actually fix the money, what that means in the end state is Bitcoin being used every day to buy groceries, gas, everything priced in Bitcoin. And if it wasn't able to be exchanged for goods and services directly, Bitcoin fails in that world. Biggest threat to Bitcoin at the moment is complacency. There's a common refrain that is everything is good for Bitcoin. But everything's not good for Bitcoin if people are complacent. One of the outputs of that is no new memes. I think we need more memes. Like Bitcoin,
we need more
not
memes.
Being complacent, because memes are powerful. If you want truth in your inflation index, just pay attention to the Ribeye, because everyone's got to eat quality food, and the Ribeye doesn't lie.
The Ribeye doesn't lie, yes. And I think that if everybody went out and started posting on X, on Noster, the Ribeye inflation index, that could become a global movement.
Yeah, so let's just stick the knife in the fiat maximus.
There you go. Hello, everyone, and welcome back to the show. I'm your host, Rob Wallace, and today I am very grateful to be joined by Parker Lewis, a prominent Bitcoin thinker, writer, and industry builder. Parker is currently the head of business development at Zaprite, a company focused on Bitcoin payments for businesses. He previously held a similar position at Unchained Capital, and he is the author of Gradually Then Suddenly, a Bitcoin book that describes Bitcoin as money from a first principles approach. Parker, how are you doing today?
Doing well, Rob. Thanks for having me on the show.
Yes, absolutely. I've been a big fan of your work for years now. And one thing I appreciate about you is your wide-ranging view in terms of Bitcoin, from philosophy to the hard economics. So we're going to jump in with a bit of a difficult question. But for you right now, what do you see as the biggest threat to Bitcoin at the moment?
Biggest threat to Bitcoin at the moment, I would say, is that's a good one. I'll say complacency. That there's a saying, or a common refrain in Bitcoin that is everything is good for Bitcoin, and everything is good for Bitcoin, but it's only because there are aligned incentives at the most foundational level of Bitcoin, being that everyone has an incentive to work to both benefit from and protect sound money, that everyone benefits from Bitcoin's fixed supply. But everything's not good for Bitcoin if people are complacent, and that refrain is only true because of people reacting to incentives. And what I mean by that is, kind of not having the eye on the ball in terms of points of centralization in Bitcoin to work on further decentralizing Bitcoin at every layer, which is a foundation of its security and why it works. And then kind of getting wrapped up in buying Bitcoin and, on leverage and fiat leverage, and missing maybe what, actually creates value, being infrastructure to make Bitcoin a greater utility. And I'm not just talking about payments. It could be custody infrastructure, mining infrastructure, that, the fiat arbitrage is inevitable, but there's a lot of important work to be done. And, I think it's important to at least focus on that.
Where do you think that vigilance has gone? I mean, is it just because that we've matured to a point that we have these Bitcoin treasury companies and ETFs here that people seem to have taken their foot off the gas? But it seemed about like 4 or 5 years ago, people were much more hardcore about the foundational principles of Bitcoin compared to where they are now.
I think that it's probably a combination of somewhat of fatigue. There's still vigilance, there's still people that, at every layer are working. Square just announced their proto hardware and software for mining, which is a key point of centralization. So whether that is ultimately successful or not, that's a demonstration of individual interests pursuing their self-interest, and also at a time focusing on decentralizing Bitcoin. And people are constantly reviewing Bitcoin's code base. So I'm not suggesting that vigilance is gone. It's just that fatigue, like working on Bitcoin is not for the faint of heart, and it's easy to be fatigued, and the last several years have felt like a grind. So it's like, and that's also at the time where Bitcoin's sitting at, north of 100,000, and the 200-day moving average is right around 100,000, which is pretty remarkable. So I think that it's partly a function of fatigue, and then it's also a function of potentially, when things appear to be a more direct threat, like something happens that presents a threat, then that kind of awakens the beast of people being more diligent. So I think it's natural, but it's also just important to realize that, everything's only good for Bitcoin because of high agency people and a network of aligned incentives around Bitcoin's fixed supply, but ultimately people building tools and infrastructure to further Bitcoin's decentralization constantly.
Yeah, and one thing about Bitcoin is that you can constantly find different rabbit holes to go down, right? I mean, you were in
A lot of rabbit
custody,
holes.
yes, and then now payments, and now you've got a new podcast, Center of Hash. So you are diving into Bitcoin mining and energy in particular. So why does this interest you at the moment?
Sure. This is an example of one of the things where I see, I think not, just me personally, I think there's a fairly broad appreciation that there is, one of the most centralized part of Bitcoin is Bitcoin mining. The Center of Hash podcast that I'm doing, this part of TFTC is focused on mining and energy. It's, the reason I'm doing it, or the original inspiration, was to help further mining decentralization, which is one of the most centralized remaining parts of Bitcoin. It's also, at least on the pool side, an aspect of within Bitcoin mining that has become increasingly centralized despite the ecosystem of Bitcoin mining growing significantly. And I think bringing discussions to the forefront about incentives of the network and the importance of different aspects of the mining ecosystem are important to that end of decentralization. But on top of that, I wouldn't be doing it if I just felt that way. I'm also very interested in the energy side of Bitcoin. I think that most Bitcoiners have gone down the Bitcoin rabbit hole and the money rabbit hole, and they appreciate the dependence that Bitcoin has, and that it only works because of proof of work and its connection to energy consumption. And that's something that also confuses a lot of people. But if money is generally taken for granted, which it is because it's always just worked, that energy also is largely taken for granted. The complexity of energy systems, not just energy supply chains, but a modern power grid, or how when you flick the switch on, at home, the light turns on, or the AC is running whenever you want it. That is a luxury in the scheme of the world. It's a complex system, and Bitcoin actually, is not only secured in part, in large part by energy. It's one of the key parts of the security columns, but ultimately Bitcoin will secure energy systems, that it will solve problems for energy systems. So it's a subject matter that I think is a deep rabbit hole to go down. It's one that a lot of Bitcoiners, kind of know topically. I'm somewhere, in the mid curve that that's not an expert, but that knows enough to ask good questions. And I've got a network of people, and there just isn't a show that is dedicated to that. And so it's a subject matter that interests me, but it's also a part of the Bitcoin ecosystem that could use further decentralization. And so it's not just a conversation on mining, it's a conversation about energy, the connection to Bitcoin, the money, how the money incentives dictate the demand for the energy, and then how mining fits into that. And then also at Zaprite, being on the payment side, the mining ecosystem is, I don't say ground zero, but it's a core part of the early Bitcoin payments ecosystem. And it naturally is, because 100%, or virtually 100%, there might be energy arbitrages that miners take in terms of strategies where not 100% of the revenues are coming from Bitcoin. But by and large, the vast majority of mining revenue comes from Bitcoin, paid in Bitcoin, and then that distributes through the supply chain. So from decentralization to my interest in the subject matter, it being a deep rabbit hole, and then also its alignment with what we're building at Zaprite on the payment side.
And you're the right man for at the right place at the right time, right? In terms of you being in Austin, in Texas, where Bitcoin mining, that's pretty much the capital, you could say it's the capital of the world in many regards, right? And now Bitcoin mining has really integrated itself into the grid in Texas over the last couple of years. Can you describe the relationship between the Bitcoin miners in Texas and the power grid there?
Sure, yeah, and it's one of the other, one of the other reasons why I felt, that I was not only was an interest of mine, but I was in a good place to be well connected with a lot of people in the industry. Being here in Austin, I also co-organized the Houston meetup, and have been doing that for the last 4 or 5 years, facilitating a lot of these similar discussions, just in a public setting, but a local setting. And to answer your direct question, and in many ways, colloquially, I think about Austin and Texas as the center of hash when China banned Bitcoin mining in 2021 and Bitcoin's hash rate went down by 50%. A lot of that hash rate came to Texas. It went to a lot of places, but it also reinforced to market participants in the mining ecosystem that if you are going to endeavor to invest material amounts of capital into the activity of Bitcoin mining and the business of Bitcoin mining, that the regulatory certainty and the interest in economic development of energy resources to drive cheap power is critical. And Texas was a natural home for that. Bitcoin is mined everywhere and is going to be mined everywhere, but for many compounding reasons, Texas has naturally become the epicenter and will be, and then it will, expand out from that center of hash. And so, thinking about it in the context of Texas and the ERCOT grid, one, there's 3 grids in the United States. There's East, West, and ERCOT. And ERCOT is specific to Texas, and there's some points where the grids are connected, but importantly, ERCOT is regulated by the Texas legislature, not FERC, not the federal body that regulates the other 2 grids in the United States. And my understanding right now that Bitcoin mining, there's between 3 and 4 gigawatts of power on the ERCOT grid. There's also a lot of mining in the oil field out in West Texas, North Texas, East Texas. Natural gas is a byproduct of oil drilling, and natural gas is a feedstock to mine Bitcoin to generate power on well sites is a logical activity. But speaking to the grid and thinking about how Bitcoin is interacting with the ERCOT grid at peak, I think max it's ever been has been somewhere around 90 gigawatts in the peak of summer in Texas. But even on hot summer days, that peak to trough is between 40 to 50 gigawatts, going up to intraday change of 40 gigawatts incrementally of power. And that Bitcoin can actually help solve a problem for grids with greater scale, as it's able to absorb more of the underutilized energy infrastructure, specifically thinking about generation capacity and transmission capacity, that can then come offline at periods of peak demand where there are scarcity events, and rather than bring more power resources online, demand can come offline. So it's getting to be at the scale where I'd say that people at ERCOT are starting to appreciate the benefit of a very unique demand for power, and one that is both large and flexible. And Bitcoin really is unique in that sense. It's a function of both. It's not just its flexibility; it's that the scale matters. Because if you had a grid that was going from, say, 50 gigawatts of power in the morning to 90 gigawatts of power in the afternoon when the day is hottest and the demand for power is greatest, well, if you could only pull off 100 megawatts of power, it doesn't really do a dent to that. But if you can supply 3 to 4 gigawatts of power when it's needed most, it solves a serious problem. And there's complexities of where, it depends on where that power is and where there are potential imbalances and where you can help stabilize. But the larger it is, the better it is, or in terms of the impact it can have. And I only expect that to increase. There is some hesitancy, I'd say, from the legislature's perspective of not necessarily understand. It's like ERCOT. The operators at ERCOT seem to understand the benefit of Bitcoin more than, say, the legislators do, and the legislators are ultimately the ones that regulate ERCOT and the PUC, the Public Utilities Commission. But it's all just a matter of education, and that's part of what the podcast is about. So we'll be going into in-depth, conversations about ERCOT, the connection to Bitcoin mining, how Bitcoin mining is solving a problem, what concerns are, and some concerns are real, because if a large load comes off in a very quick way, which Bitcoin miners can, if they're responding to price signals, that you need that controlled, because that quick shut off can also create problems. So might just need people to stair step down slightly longer rather than all at once. So but yeah, kind of that gives a sense of scale, like 3 to 4 gigawatts, on a network that is 45 to 90 gigawatts of power and growing.
Mm-hmm. And it's such a fascinating industry in the sense that it started 15 years ago from people's homes, mining on their computers. Now it's integrated into large power grids like ERCOT. And so in the future, moving forward, do you see this centralization continuing with these large mega farms in places like Texas, or do you think it will be distributed? We have the heat pump movement. We have the bid-axe movement. People are mining at home, mining for waste heat, and using waste heat for industrial purposes too. So do you think it'll be more spread out, or in these mega farms like Riot has over there in Texas?
I think it will be all of the above. And one of the things I think about is whether or not Satoshi or whoever it was that created Bitcoin had an appreciation for the scale of power that the Bitcoin network would demand, and how that could help solve problems throughout the energy system, whether that person actually kind of saw this part of the future. But I think that maybe the framework that I would put out is that Bitcoin mining and scale will go to wherever there are large amounts of wasted resources. And so in the context of an energy grid, the way I think about wasted resources is the duck curve, and that you have this generation capacity that can serve 90 gigawatts of power in ERCOT, but that 90 gigawatts is only utilized for a very small amount of time, and that there are other potential solutions to it, like batteries. I think will be a combination of batteries and Bitcoin mining, because they solve different problems. They in certain ways seem to solve a similar problem. Like if a generator comes offline, Bitcoin can't provide more power to the grid, and a battery could, but Bitcoin miners can also shut off and respond to increasing demand, like a battery could. So it's like they have overlaps, but that swing of power demanded, over the course of a day is a phenomenon of real economic activity, and that's not going away. And so long as there are large grids, then there will be large mines. Now, in that context, I think that they will shift to being at points of generation, like where there is a combined cycle turbine, or where there is a nuclear power plant, or a coal fire power plant, that it might be like less distributed, in terms of just being, pulling off the grid at a substation. But there's capacity, for a lot of generating assets that could be utilized. And I think it will reshape how people think about that. At the same time, I do not think it's not, people oftentimes think about, and again, this is something that I'm still exploring, but the more that I talk to professionals that are actively working in Bitcoin mining and energy, but are entering the Bitcoin mining space, it's not a game that, scale always wins, where a lot of times people think, well, if I'm at larger scale, if I can manufacture, more at a single facility at greater scale, my marginal cost goes down, that the nature of cheap energy doesn't necessarily scale the same way. And there are always going to be pockets of really cheap energy that might not be at as large a scale, but are cheaper. and able to be monetized more profitably than, say, being on the grid where there's more competition for power, and where energy resources, even if they're stranded, they're marginally less stranded. So I think it's going to be all of the above, and that, over time, energy systems will find ways to be more efficient, and Bitcoin mining will go from one place to another as the demand for power can be used for a higher, better source. And that's one of the unique things about Bitcoin as well, that it's really location agnostic, purely economic, which makes it unique.
Yeah, these miners can just pack up and go, which is, as you said, very unique to this industry. But another unique thing is that you can point your hash wherever you want to, right? But one issue that you've been trying to tackle on your show is the problem of mining pool centralization. And we just saw this week that the combination of Foundry and Ant Pool together now have more than 51% of all hash. But of course, if you add the proxy pools under Ant Pool's umbrella, that could be well above 60%. So I know you've asked numerous guests now as to what is the answer to this issue. Have you come any closer to getting an answer?
Yeah, I mean, I think that, well, I'd say the part of it that I don't have as good of an answer for is why, like, the mechanics that have caused Bitcoin mining to centralize. And there's something that people oftentimes point to, which is the Bitcoin miners, the people that are actually hashing their, the term addiction is used, but their preference, to use a less loaded term, for a fixed payout per day.
I wanted to briefly interrupt today's interview to give a big shout out to our lead sponsor, Rhino Bitcoin. Rhino is the all-in-one Bitcoin super app built by Bitcoiners for Bitcoiners. Buy or sell instantly. Send sats anywhere on the Lightning Network. Withdraw straight to cold storage. Even turn sats into gift cards or link to a Casa multisig, all within one sleek interface. And Rhino is just warming up. Soon, you'll pay bills, borrow against your Bitcoin, and save for retirement, all without leaving the app. Download Rhino at rhinobitcoin.com or tap the link in the description below. Use promo code Bitcoin News and Rhino will drop you $10 of free Bitcoin into your account today. Secure your stack with Rhino Bitcoin and enjoy the rest of the video.
That, to me, like, it might be the answer. It seems like a very non-rigorous answer when it comes to economic incentives. And so I don't have a great answer there of realistically, like, why over the last 5 years, despite Bitcoin hash rate increasing by approximately 180 to 200 times, why you'd expect with greater scale something like mining pools to become more distributed. Now there's a reason why people aggregate hash rate and why there likely will not be thousands of mining pools, and realistically why it might make more sense for miners and in the network for there to be tens of pools or hundreds of pools rather than thousands of pools. But going from 20 pools to functionally 3 that control 70-80% of the hash rate is, I think, not something that most people would have forecast if you said, hey, Bitcoin hash rate has increased by 180 times since 2017. What do you think has happened to the pool landscape? Now, that being said, the answer in my mind is more pools and people following economic incentives, which they are. Ocean's pool has opened up and they're starting to accumulate more hash rate. I believe it's somewhere over 10 exahashes now or somewhere there around. Demand pool is I don't believe live, but being worked on. And the miners themselves, in my view, do not, like, I don't want to say in my view, fundamentally, economically, they do not have an incentive for there to be centralization. At the pool level, they also do not have incentives for there to be centralization at the hardware level. That will be the foundational incentive that dictates other options come up, but people have to build those, and then those other options have to be adopted. So Ocean seems to be the most or the newest entrant that's starting to get meaningful traction. But that's part of it. And then the other part of it, one of the attractive things, I just had Mark Artemko on the show 2 days ago. We recorded. It'll be out next week. But also providing a way for miners to be paid out directly from the Coinbase transaction, which is a protocol that Ocean is utilizing called Datum, and that also not only is the entrant of Ocean that kind of helping to provide a another option to Bitcoin miners, but also with a different approach that puts the pool in less control. Allows miners to directly peer with the network, to run nodes and actually broadcast blocks directly, construct blocks in a way that functionally the pool can't block or censor. So I think the short answer is more pools, but miners have to adopt them in their own interests, and then kind of I think getting off this fixation on a fixed pay per share. And realizing that a lot of these pools are black boxes, and there's no way that or they're paying for hedges. Like in many ways, the miners that are opting for these pools that offer fixed payout per share, which Ocean just pays out as blocks are solved, which to me is a more aligned economic model. That these miners have gravitated towards the fixed, consistent payout, but they're basically paying for a hedge to variance that they can't quantify. It's not like, hey, here's the pool fee, and then this is what you're paying for this service to take away your variance, and they're going there for the purpose of taking away the variance. But they can't quantify what they're actually paying for that. And I'm still searching for this question or the answer to this question, but it would seem to be that activity, based on what I know of hedging the price of Bitcoin in an over collateralized way, which I know to be cost prohibitive, that hedging the variance of block production is likely also cost prohibitive. So I think that's an economic incentives that more miners are going to need to explore, and might be more consequential than the marginal fees made on mining JPEGs and other scams.
And you have a finance background, and one thing you always bring up is economic incentives, right? And that's what makes this world of Bitcoin spin. It's what makes it all work. So could you explain to the audience on a basic level what economic incentives make Bitcoin so strong and resilient in your view?
The two things that I would point to are Bitcoin's fixed supply being the foundation of everything, and that everybody in the world has an interest to be able to access permissionlessly a form of money that can't be printed, and that the credibility of Bitcoin's fixed supply only exists because of decentralization. And that decentralization is a word that has been trivialized by charlatans and snake oil salesmen in the crypto and DeFi communities. That something is not decentralized because you say that it's decentralized. And that centralization, or in the context of Bitcoin, decentralization, is not trivial. That the only reason why Bitcoin has a credibly fixed supply is because no one can control the network, no one can censor the network, and you don't really know how uncensorable Bitcoin is until a threat emerges, until someone tries to censor it. But censorship can come in two ways. It can come in the form of, somebody sending a Bitcoin transaction from a Bitcoin address that has Bitcoin that hasn't previously been spent and not getting validated, or it could come in centralized forces trying to change the rules of the network. That both of those are the core kind of vectors of censorship. And so thinking about those two ideas, the Bitcoin is valuable because it provides this form of money that can't be printed, but the form of money that can't be printed can only not be printed because the decentralization exists, and that decentralization exists as it relates to the fixed supply, is everybody pointing a gun at each other without the incentive to allow anybody else to print money, and that they are willing to cede their own inability to do that in the interest of not allowing anybody else to. And that's really what aligns all incentives. Everybody has the incentive to sell money, and everyone has the incentive to not let anybody else print money. And that's why Bitcoin is secure.
Yes, this Mexican standoff analogy is a beautiful one when it comes to Bitcoin, and it keeps everybody playing the game in a way that is beneficial to everybody else. But now we have TradFi coming in, and they look at Bitcoin as a hedge. But one of your most popular presentations is Bitcoin is not a hedge. So what would you say to them in this regard?
So my comment on Bitcoin not being a hedge is that Bitcoin is ultimately the solution to inflation. It's not a hedge to inflation. And there are many things that can hedge inflation, and the things that can, and specifically talking about hedging US dollar inflation or the rise in prices. Hedges to dollar inflation are things that are correlated to the US dollar, things that make more dollar income as the supply of dollars increases. And Bitcoin can offset in the way that most people think about a hedge of inflation. Bitcoin can be that. You could say, hey, Bitcoin has increased in purchasing power more than the dollar has inflated to date, and it should always continue to do so. Point being, though, is that it's actually the solution to inflation, and only a better form of money can fix the problem of having a broken money. That if your problem is inflation, you're never going to actually fix that problem, and the root of all inflation is the printing of money. So if by derivative, if your problem is the printing of money, you're not going to solve the printing of money by owning more real estate and hedging inflation, because ultimately the money is going to fail, and the only way to fix a broken money is with a better form of money. And so that's the foundation of the idea that Bitcoin is not a hedge. And then the other side of it is that it can't be a hedge, because on the knowledge spectrum, if you have not yet figured out that Bitcoin is actually the permanent solution of inflation, you have limited knowledge, and Bitcoin's volatility is going to destroy you. So if you think about the fact that Bitcoin has offset inflation for anybody that's been holding it since Bitcoin was $1,000 or $10,000 or $20,000 or $50,000, but if somebody bought it last week at 124,000 and then panic sold it at 114,000 because it dropped a little bit, Bitcoin was not a hedge to inflation. And that it's impossible to stay somewhere in between the spectrum of having a lot of knowledge of Bitcoin and having imperfect knowledge. Once you start to realize that Bitcoin is the only thing that can actually fix the money, and that what that means in the end state is Bitcoin being used every day to buy groceries, gas, everything priced in Bitcoin facilitating virtually all the world's commerce on a direct basis, exchanging money for goods and services, that's the end state. You don't look at it as a hedge to inflation. You figured out that it's replacing something. And if you haven't figured that out, then you're either going to sell Bitcoin when it goes up by 20%, or you're going to sell it when it goes down by 20%. But in either of those worlds, it didn't hedge inflation for you.
Yeah, and it doesn't seem like TradFi has really got the fact that Bitcoin really is outside of the system, something completely new, a system that we can build on for a new beginning.
And what I would say is, like, there are certain people that are probably on their path to that like figuring out that Bitcoin is the solution to inflation starts with consuming some primary education, connecting it with something that happens in the real world that reinforces that the ideas that you learned were probably true. Like Bitcoin, can't be printed, and they're always going to have to print more money. And then when a central bank prints trillions of dollars, you put two and two together. At that point, Bitcoin still cannot be hardened in your mind is going to permanently fix the money and replace the money. But you're now on the curve where you're descending down to a point of inevitability, that you're going to get to that point. And so, like, what I would say is that there's probably some people that have been drawn in by the TradFi world, and they're starting to pay attention more, and like, hey, if BlackRock's doing this and Larry Fink's saying some of the things that he's saying, there's probably some signal here that I need to pay attention to. And I'm just kind of caveating that moment, it's like that it's a process of hardening. And so a lot of people are being sucked in, and they will get down to that endpoint of seeing Bitcoin as the permanent solution to the broken money. And when they figure that out, they're going to sell the ETF and ask for the real Bitcoin, or take it in kind if they're able to.
Absolutely. It's a process, and it takes years of study, education, listening, reading, and talking about Bitcoin to get to that point. But TradFi, as we said, probably isn't there yet in total. And so we've seen the proliferation of Bitcoin treasury companies. And those are certainly a hedge, right? They're trying to make more fiat off of Bitcoin in order to outpace inflation. But we've also seen them a lot of them blow up in the last couple of weeks to the last 2 months. Do you think that this trend will continue? Will they have new life breathed into them as Bitcoin price hopefully goes up during the rest of this cycle? Or do you think that this was a trend that has now seen its day?
I think that the opportunity to arbitrage fiat, to be able to go into the fiat capital markets and take on creative, efficient leverage to buy more Bitcoin, is an inevitability. And that has everything to do with the nature of fiat, and the broken incentives in fiat. But it exists, and you can't deny that it will exist. I think that it's going to be difficult for many of these vehicles to exist because somebody's going to do it best. And so, and maybe it's one or two per market, right? Like maybe it's MicroStrategy in the US, maybe it's a second, that has, I don't know what, but all I'm saying is like, it's illogical that there would be, 10 of them that are successful, because they're all competing with each other, and someone's better at the game than the others. But then there could be, one or two in every market, or every market where there's a deep and liquid capital market. So London, Frankfurt, Hong Kong, like maybe a few of these exist, and will exist so long as you can arbitrage fiat, which you should be able to until fiat is no longer functionally bid.
Yes, and I guess some people will have some Bitcoin exposure in these Bitcoin treasury companies, but I think both you and I agree that the majority of your Bitcoin exposure should be in cold storage under your own control. You worked in custody for a number of years at Unchained. Do you have any tips for people who are holding Bitcoin in cold storage? How should they do it? And what pitfalls have you seen?
Yeah, I would ultimately, for the vast majority of people that have a meaningful share of their wealth in Bitcoin, I would highly encourage people to take control of their own destiny, and that securing Bitcoin is not a technically hard thing to do. It is something that you need to be very diligent, and that you have to be the type of person that's high agency and that is willing to take on responsibility, and plan things. And that, that also comes with, when you take on responsibility and you take on accountability, there's a possibility that you screw things up, and that the solution for that is redundancy and backups. But knowing, hey, if you are not responsible and you are not accountable and you are not diligent, there's no way to give you unilateral control of your wealth in a way that someone can't censor you, and then also say that there's zero chance that you screw something up. But that, in the way I secure my Bitcoin is through Unchained, and it's using multisig in a way where Unchained holds one key and I hold two keys, and my keys are backed up and distributed, and in that world, many different, I don't want to say mistakes could be made, but things could happen where a key could become inaccessible, or a key and a second key could be inaccessible, or a key and a second key and a backup to a key could be inaccessible. It's like, as long as two keys and two backups do not become permanently inaccessible, at the same time, high degrees of redundancy, and can move Bitcoin. And that there's a partner like Unchained, and Unchained is not the only one who has a model like this, but that model to me is the way to secure Bitcoin with the greatest assurance of security. But it's not for everybody, and then it just becomes down to what trust model and how trustworthy counterparties are. And certainly working with Bitcoin only companies, if you're going to trust companies, a company like River, something like that. But I would encourage, just like, if you have a meaningful amount of your wealth in Bitcoin and you're doing that intentionally, not as a Hail Mary, and you're not trying to sell it if it goes up by 40%, then you've been diligent enough to get to that right answer. And one of my friend Will Cole would say that that securing your keys is like driving a car. It's not really hard, but if you're not diligent, or you don't learn how to drive before you get behind the wheel, or you drink and drive, you can do some damage to yourself. But it's not rocket science.
Yeah, it's not. But I think one thing that's also not talked about often is the fact that it does require some practice in order to stay comfortable with it, right? If you've got all your money on a hardware wallet, you got to be able to check, make sure the device works, send transactions out, receive transactions on the device, make sure that you are still fluent in the art of self-custody, and it's not just something that you practice once and then forget about forever.
Yeah, I mean, what I would say is I would never secure a meaningful amount of my wealth on a percentage basis or an absolute basis on a single hardware device. I would eliminate single points of failure. But then what you said is absolutely true. That if there's a most common pitfall that I would see is people not taking the steps that they're instructed to take, like in terms of distributing keys, not being diligent about that. Like that is where personal responsibility comes in. But then also it's like your memory becomes stale. How these things work, there's if you leave a device in a place for 5 or 6 years and never check to see if it works, electronics sometimes fail. It's referred to as bit rot. People probably had a brick phone that just never turned on because it was super old. Same can happen to Bitcoin hardware wallets, and it's really not a risk if that happens if you have a setup with redundancy. But if you don't know that for years at a time, what you end up stumbling into is the possibility of multiple failures that can happen in parallel to each other. And so being on top of that and periodically checking your devices to making sure things are in working order, and that could be something like once a quarter or once a year. You just don't want to leave it to years without jogging the memory or not having a plan in place.
Yeah, and checking these devices, using them, sending Bitcoin, receiving Bitcoin is natural when you are using Bitcoin for payments. And that is what you do now at Zaprite. And you've been there for 2 years plus. And I'd love for you to tell us about how you've seen Bitcoin payments grow in America over those last 2 years, and what things have surprised you.
Yeah, I mean, it's becoming, what I'd say is like the biggest shift in the last 2 years is that it's becoming a lot more common for people to be interested, to say like, hey, I want to do this. That if you went back 2 years or 5 years, there were people accepting Bitcoin as payment, and there were people that were, Bitcoin centric businesses accepting Bitcoin as payment. And then there were people that, understood Bitcoin that weren't, didn't have Bitcoin centric businesses, that just could have been a doctor or a lawyer, that were accepting Bitcoin payments. But it's becoming far more common for people to be interested in turning this on for businesses that are not Bitcoin centric. We focus very much at the core of the businesses that are Bitcoin centric, and then kind of try to reach that next wave of people that aren't, based on the ones that might interact and experience Zaprite and pay a Zaprite invoice or purchase a ticket, being somebody that has a business that isn't, but they're on the next wave. So that's what I'd say is what I've seen. I mean, it's definitely, small, Like the market for Bitcoin payments is small, but growing very fast. And then the other thing that I'd say I've learned that is a challenge to overcome is that there are more businesses that are interested in accepting Bitcoin payments than the market and the service providers, including ourselves, are able to satisfy. Because if you think about if you thought about the network distribution in the real economy of people that have come to understand Bitcoin and that want to accept Bitcoin as payment, in most cases, if you can't meet the business exactly where they're at, it's going to present a friction that doesn't say like cause somebody to shut down, but it just doesn't become realistic. It's like, if you think about a business, say like, a restaurant that uses toast, toast is probably the, most popular point of sale or probably fastest growing point of sale for businesses. They've adopted that point of sale because the point of sale is solving a lot of operational problems for them. And, just using the example of toast, they've created a solution that overwhelmingly restaurant owners are opting for. If you don't integrate Bitcoin payments directly into the toast interface, then for those businesses, accepting Bitcoin payments would kind of it would introduce a friction that would almost make it not overcomable. Now, as soon as they do, a bunch of those businesses that use Toast are going to turn it on. Another corollary is, where Square has announced that they're going to start accepting or enabling Bitcoin payments to their terminal, and they're in the process of turning that on, that all those businesses that need the Square terminal and the Square terminal is right for, they're going to be able to access it, but they wouldn't have turned it on because they weren't going to switch their terminal necessarily, because the reason why they choose a terminal. So it's like it is difficult to meet every business that wants Bitcoin payments where they're at, because commerce is so unique to the nature of each business. And I think that that's one thing that that I appreciated, but I've come to appreciate the extent of it, of just how distributed in terms of the difference of maybe even businesses doing the exact same thing, of the nature of the tools that they rely on. And so our job is to not be everything for all people, but to focus on delivering the solutions that can be the right solution and deliver a great payments experience for a critical mass of people to make Zaprite a profitable business and to find product market fit. And then as we do that, to branch out from there. But the acceptance that like, hey, some people we just can't, go out and build a solution for because it's a market of one or two. That's the reality.
And one hurdle that needs to be overcome in all this is that people think that Bitcoin is still just for savings. But you've written that spending Bitcoin is logical. Explain that.
Sure. So the way that I would frame that is that one, Bitcoin's money, and that at a foundational or fundamental level, the idea of something being a store of value and it being a medium of exchange are undivorceable. They're one and the same. That you think that you're storing value in Bitcoin, and you are, but its ability to store value is predicated, and the value that you derive from it is predicated on a future exchange. Even if you are not exchanging it, even if you plan to never spend your Bitcoin and pass it on to your heirs, the value that you derive from it comes at the point of future exchange. And you had an exchange on the front end to acquire it. You store value over some period of time, and then you exchange it on the back end. And so really, and then another way to think about it from an economic standpoint, that idea of, a store of value not really being able to be divorced from the medium of exchange, even though people talk about it differently. And the distinction really is, well, what mediums are you exchanging it with? Are you exchanging it, Bitcoin for dollars? What's the time horizon? But if you meet someone where they're at that says, hey, medium exchange means Bitcoin being used as a transactional currency to buy goods and services, which colloquially it is, then you'd say, well, if Bitcoin were only exchangeable for dollars, and if the endpoint was that it wasn't able to be exchanged for goods and services directly, Bitcoin fails in that world. That's where you come back to that, earlier idea we talked about, that if the fiat system is a necessary choke point to get to the real economy, to be able to convert your store of value into goods and services, but you have to go through the fiat system, then it inevitably means that the Bitcoin was not sufficiently decentralized, because the only way that could result is because of somebody creating a law that says you have to do that. And the reason why is because Bitcoin is perfectly technically capable of being transacted for every form of commerce in the world. Real estate, oil, point of sale, buy credit card if you want to, buy tap to pay if you want to. There's a reason why stocks and bonds and treasuries are not functional as money, why they cannot be transacted. Being that they're inherently both trusted, and they necessarily, by the very definition of them, include counterparty risk. Bitcoin being different, being money, you can actually transfer Bitcoin, whether you're sending an on-chain transaction or a Lightning transaction, where I had the money and now you have it and I can't get it back. And that can happen in obviously an on-chain transaction has to settle on-chain, but once I've sent it, I don't have a practical way of reversing the transaction. Now I could try to, send the same Bitcoin somewhere else and pay a miner and an accelerator fee, but practically speaking, once it's sent, it's yours and not mine. And then when you tie that in together to say, hey, if Bitcoin is technically capable of doing this, and then if it were not to be used that way, what would be the logical explanation? It would be because a centralized force said by fiat or dictate that is illegal, and Bitcoin wasn't sufficiently decentralized to undermine that kind of higher level mandate. Then I would say, in a real perspective, that why it's logical to spend Bitcoin. So first, establishing that, hey, a lot of people think about store of value, but store of value being exchanged, the more exchangeable it is, the more people that are willing, if you could buy just dollars versus if you could buy dollars or beef or chicken or gas, it's more people bidding for your money. So the more exchangeable it is, the better it's able to store value. Is also how the two concepts interrelate with each other. And then the logic, so if you start to understand that these two things are one and the same, then the logic of spending Bitcoin is that there's two things that people worry about when they're spending Bitcoin. And why each of those are irrational is that if you're worried about your Bitcoin going up, then what you're talking about is not a dilemma in spending Bitcoin, it's whether you should spend it all. Because every time you spend fiat, you have the same dilemma, and you're not admitting it to yourself. Because if you were going to spend fiat on something, you are not worried about its price going down. You might be spending it because its price, you're not spending it because you're worried about its price going up. You're spending it because you're not considering it going up or down, or you know that it's going to go down in the future. But you could take that fiat and convert it to Bitcoin. And so what that amounts to is that you really have a spending dilemma versus a saving dilemma. And we're not talking about spending Bitcoin. We're talking about the cost of saving in fiat. And if you've saved in Bitcoin for long enough, and then you get to a point where you have a lot of Bitcoin and very little fiat, spending Bitcoin becomes very logical. And in the article that I wrote, the logic of spending Bitcoin, just as a thought exercise, I said, hey, assume that you saved 100% of your money in Bitcoin, you would have to spend Bitcoin. And you wouldn't be thinking about this dilemma, because you have to eat every day, you got to drink water every day, you're consuming power, you have needs and wants, and all of those are valid. Not every one, but if you decide that you actually need or want something and it's valid, then the spending money, money is there to not stare at our digital wealth. It is there to get things in the real world, to coordinate trade, to facilitate commerce. And then the other side of it is hey, if you only have 1% of your savings in Bitcoin, yeah, you probably shouldn't spend that. You got a lot of fiat. You probably have too much fiat, and that you should think about getting more Bitcoin. And then when people talk about the taxes, it's like, well, hey, if you saved in Bitcoin and it increased 10 times and you've got almost all Bitcoin and very little fiat, it's like, yeah, you're going to have a capital gains tax on the amount that your money increased in purchasing power. And the other side of that is that if you made the reverse decision, then the purchasing power of your money would have gotten destroyed. And so you end up with more money if you are able to save more in Bitcoin. So, and at the end of the day, everyone's going to have to spend Bitcoin because it's going to be the only form of money that works. And people that are high agency, either if that's business owners that are asking to be paid in Bitcoin, or it's Bitcoiners that recognize this, that if no one realized it, then the tools wouldn't exist when everyone in the world is going to need them. And so, it's like, it's not a call for everyone to go out and spend their Bitcoin. There's no moral imperative to spend your Bitcoin. It's just like, hey, if you think that it's illogical to, there's a logical gap. There's a logical inconsistency at one level or another.
Yeah, you're right. Most people are probably saving too much in fiat, and you see that in the destruction of your purchasing power. And one of the memes that I'd say that you've really helped proliferate recently is the Ribeye inflation index. So you've been going to your local butcher and just documenting the price of ribeye. Explain that to the audience, and what's the change you've seen over the last couple of years?
So the Ribeye inflation index is the best way to distill down real inflation, and it's it's true, it's true, but it's also a troll for the fiat maximalists out there that want to distract you with bullshit metrics like CPI that hide and distort and underreport real inflation. But the idea is that, I mean, you could realistically do this, not with any commodity, but one of the ideas is it's a raw piece of meat. Maybe there's some degradation, maybe the quality of the beef has gone down, but a ribeye is a ribeye is a ribeye. And if you look at a ribeye at the same store, same piece of real estate, it's like, the one thing that's changing is the price. It's the, if you look at a prime ribeye to a prime, 4 years ago to a prime ribeye today at the same location, you're isolating all variables, and food is one of the most important things you have to consume every day to survive. And it's also something you can't fake. There's proof of work in beef. It's got to be raised and it's got to be brought to market. So there's a lot of ways that people can hide inflation, and they can't hide it in quality food. And so the ribeye that I started tracking, I had noticed that, and this was during the COVID lockdown, that the Federal Reserve printed $5 trillion, $3 trillion from March of 2020 to May of 2020, and $5 trillion from that period over the subsequent 2 years, like $5 trillion in total. And about a year after that, I noticed that the price of ribeye at my grocery store had increased by 10%. And the Fed was reporting like 4% inflation. And I'm like, hey, to me, this is something I eat. So my inflation, which is food, which I have to consume every day, is this. And then I just started realizing every time the price would increase. And I think that is something that occurs in hyperinflation. I genuinely believe we're in the early stages of hyperinflation. But that same ribeye that costs $19.99, and this is a nice ribeye, but the important thing for your ribeye inflation index is that it's the same ribeye at the same place. The variables are isolated. You could go look at the choice ribeye too if you wanted to, but then you'd have to compare to the choice ribeye. But that ribeye was $19.99. It first jumped to $21.99, so 10% approximately from 2020 to 2021. That same ribeye is now $32.49. So, 12 over, or 12 and a half over 20 is over 60% inflation over 5 years. And so, simple average 12% a year. And it's a commodity market. people, and the thing is when I raise this for people, they'll say, oh, there's a drought, or there's a herd shortage. It's like, well, yeah, everyone needs to consume beef. And when you look at a market like the United States, the fact that herds are going down is a function of fiat and fiat money printing. It distorts economic activity, it causes people to substitute, demand is destroyed, supply is destroyed, it becomes more costly. And it's like, yeah, we recognize that there are things that can happen that, cause a short-term rise in prices, like a drought or like a storm, that cuts out some supply chain. But the only thing that causes long-term structural inflation is the printing of money. So it's partly a troll, but it's also, if you want truth in your inflation index, just pay attention to the ribeye, because everyone's got to eat quality food, and the ribeye doesn't lie. The ribeye doesn't lie.
I love that. The ribeye doesn't lie. Yes. I mean, I think this is a meme that could spread, right? And we should implore all Bitcoiners across the country and around the world to document the price of meat at their local grocery store. And through that, it really opens the eyes of the average person as to the destruction of their purchasing power. And I think that is the greatest teacher and nudger into Bitcoin, learning more and spreading the adoption of this, the world's most scarce asset. But as we round out here, I want to have a little fun. So we're going to continue on the idea of memes, and I'm going to have 5 Bitcoin sayings, and we're going to power rank them. Once you say what place they're in, it can't change, and you're not going to know what comes next. All right?
All right. I was actually thinking earlier today, just the fact that this was coming up, I was like, and this is just the way the world works, I was like, I can't remember the last meme, and that might, when I said that the problem is complacency, the complacency, one of the outputs of that is no new memes. I think when I was thinking about it earlier today, the last meme that I could think about was, it might have been, and I don't consider paper Bitcoin Summer a meme, like that's, but it was like, printer go burr or something.
Yeah.
Or whatever that one was. So, I think we need more memes. Like Bitcoin,
we need more memes.
Not being complacent, because memes are powerful.
Yeah, and I'll say that's one of the biggest differences between last cycle and this cycle is that we had a lot of very powerful memes that everybody was saying, and it really it helped amplify and give energy to the movement.
Money printer go burr as well. Yeah, that was the last one I could think of. Is like that was the last. Is that the last? Maybe it's not the last meme, but that was the last one I could come up with. But all right, let's do it. Good timing. Fate would have it.
Okay, so first up, you got to rank 1 through 5 is have fun staying poor.
Wait, but I don't know what the other ones are.
You don't know what comes next.
Okay. 4.
4. Okay. Up next is stay humble, stack sats.
2.
This one I think you like. Everything is good for Bitcoin.
1.
Okay, so we have 1, everything is good for Bitcoin. 2, stay humble, stack sats. All right, and 4, have fun staying poor. Next is fix the money, fix the world.
3.
And as we are on Bitcoin Infinity Day, infinity divided by 21 million.
5.
That's 5.
What did I say with 4?
4, I think you said have fun staying poor. Yeah.
Okay. Yeah, I'd probably switch after I said stay humble, stack sats was 2. I'd probably move that to 1, but and I was worried that number go up was going to be there. I was like, I don't want to make that one, but that would be it. 2 or 3.
That's another one. Yes, but we need more memes. That's
right.
That's the lesson right here. We need more memes, and I think that if everybody went out and started posting on X, on Nostr, the Ribeye inflation index, that could become a global movement.
Yeah,
so.
let's just stick the knife in the fiat maximus that hates it. More we can
All
do.
right, Parker. Well, thank you so much for your time. If people want to learn more about you, Zaprite, the book, where should they go?
Yeah, I'd say 2 or 3 things. If somebody does not yet understand why, have a clear picture in their mind why Bitcoin stores value, why it's money, Bitcoin payments are not for you, continue to listen to the podcast. My book would be a great resource. It's on thesafehouse.com. It's Safe Dina Moose's website and distribution platform for books. Safe Dina wrote a book called The Bitcoin Standard. I also recommend that. But you can find my book, Gradually Then Suddenly, on his website. So it's The Safe House, and safe is spelled SAIF, thesafehouse.com. Then if you are one of those people who have already gone down the rabbit hole, understand Bitcoin, and you run a business or are a key operator in a business, I'd highly encourage you to evaluate accepting Bitcoin as payment. And we would love to have a discussion with you at Zaprite. You can reach out to us. We have a contact form on zaprite.com, and Zaprite spelled Zaprite. So zaprite.com. If you fill out a contact form, I'll likely be the person that helps you. I work with most of our customers directly. So reach out to us there. And then if you're interested in going down the energy rabbit hole, check out the TFTC feed and look for Center of Hash. The episodes are marked by the red logo, so you can see in the feed. If you ever see a red logo, that's the Center of Hash episode. So check it out. We've got 4 out to date. The 5th episode will be coming out next week. So yeah, that basically covers the bases.
All right, Parker, it's been an absolute pleasure. Have learned a lot from you, and I think I will continue to into the future.
Appreciate you, Rob.